Welcome to the Thinking Director channel, where thinking differently leads to living differently. Let me ask you something. Have you ever held on to something, an asset, a belief, a decision, simply because it once felt safe? Not because it still is, but because it used to be. That's the danger of comfort. It tricks us into thinking we're protected, when in reality, we might just be standing still, while the ground beneath us slowly crumbles. This podcast isn't about fear. It's about awareness, because what once made you money might now be costing you more than you realize. In this series, we're going to break down 7 types of assets that most people still believe are safe, but are quietly decaying from the inside out. We'll look at why government bonds may not be the sanctuary you think they are, how dividend stocks can trap your portfolio in stagnation, why commercial real estate is becoming a ghost town, how the US dollar is silently leaking value, why your shiny new car could be a rolling financial liability, how clinging to outdated investments can sabotage your future, and finally, the one mindset shift that separates wealthy investors from everyone else. If you're in your 30s, 40s, 50s, or even your 60s, this isn't about chasing the next big thing. It's about staying one step ahead of a changing world. Because the real danger? It's not the bad investment you make. It's the good one you refuse to let go of, even when it's no longer working. So if you're ready, let's dive into the first hidden trap. Government bonds, the safe bet that's quietly losing its edge. For decades, government bonds were the go-to choice for safety. They were the sleep well at night asset. You didn't have to think twice, buy a bond, lock in a yield, and rest easy knowing your money was in the hands of Uncle Sam. But here's the uncomfortable truth. That version of safety no longer exists. Because while the label still says low risk, the numbers tell a different story. Let's break it down. Say you buy a 10-year Treasury bond at a 3% yield. Sounds fine, right? But inflation is running at 4%. Maybe even more depending on how you calculate it. That means your real return is negative. You're not gaining wealth, you're slowly bleeding purchasing power. Each year, your money is technically growing on paper, but losing its ability to buy you anything meaningful. And if you think, well, at least it's better than keeping cash, maybe. But let's not confuse less bad with actually good. Here's the thing. Wealthy investors saw this shift years ago. They didn't wait for headlines. They started quietly moving out of long-term bonds. Why? Because they understood something critical. Safe isn't about stability anymore. It's about adaptability. They asked smarter questions. Not, what's the safest asset? But, what's the smartest asset right now? Given the macro environment? Because bonds don't exist in a vacuum. They're tied to inflation, monetary policy, debt levels, geopolitical risk, real-world forces that never stop changing. And lately? Those forces have been turning against the traditional bond investor. Massive government spending, skyrocketing national debt, repeated debt ceiling battles, and central banks being forced to raise rates faster than they ever have in decades. All of that creates turbulence. And in turbulence, what used to be a cushion can become a trap. So here's the question. Why do so many people still cling to government bonds as their core, safe, asset? It's not logic, it's nostalgia. It's the comfort of what worked in the past. But wealth doesn't grow in the past. Wealth grows in the present, with eyes on the future. You don't have to ditch bonds completely. But if they still make up the bulk of your portfolio, and you haven't adjusted your strategy since 2010, it's time to rethink. Because no asset is universally safe. Only one thing is, your ability to think independently and adapt ahead of the curve. So if you're still holding government bonds like it's 1995, you might be playing defense in a game that now requires offense. We've all heard it. Buy dividend stocks, let the money roll in, set it and forget it. It's the dream of passive income, earning while you sleep. And for many people, it's worked for a while. But here's the truth no one talks about. Dividend stocks can quietly trap you in a false sense of progress. Let's start with why they seem appealing. They're stable, familiar names, household brands. They pay out 3%, 4%, maybe 5% annually. You feel like your money is doing something, earning without risk. But stop and think for a moment. What's the trade-off? Most dividend-paying companies aren't growing anymore. They're mature. comfortable. Their best years of explosive growth are long gone. And instead of reinvesting in innovation or expansion, they pay out earnings because they've run out of better ideas. Now, that's not necessarily bad, but it is limiting, because what you gain in predictability, you may lose in performance. Here's an example. Imagine two portfolios over 10 years. One is packed with high dividend stocks. The other focuses on growth companies reinvesting into their future. Guess which one outpaces inflation? Guess which one beats the market? It's rarely the safe dividend portfolio. And if you're relying on those dividends as your main income source in retirement, that 4% yield might not be enough, especially in an economy where inflation eats away 6 to 8% per year. You think you're standing still. In reality, you're drifting backward. Wealthy investors know this. They don't chase dividends blindly. They look at total return, capital appreciation plus dividends. And more importantly, they ask, is this company still growing? Or is it just coasting on its past? Because here's the kicker. A company can cut dividends any time. And when that happens, the stock price usually tanks, double hit. So no, dividend stocks are not immune to risk. They just wear a better disguise. It's not that all dividend stocks are bad. Some play an important role in a diversified portfolio. But the moment you treat them like a guaranteed income machine, you stop thinking. You stop asking better questions. You start holding on for comfort, not strategy. And that's where you fall into the trap. Because in investing, just like in life, comfort is the enemy of growth. So ask yourself, are your dividends keeping up with inflation? Are the companies you're holding still competitive in the next 5 to 10 years? Or are you stuck in a financial time capsule, hoping yesterday's winners will carry you through tomorrow? Passive income is powerful, but only when it's built on active awareness. There was a time when owning office buildings, retail spaces, or shopping centers was the definition of financial success. Commercial real estate was the grown-up investment. High returns, stable tenants, long leases. It was a symbol of status and security. But that era? It's fading fast, because today, commercial real estate is quietly crumbling. Let's look at why. First, remote work. The pandemic didn't just change where we work. It changed how companies think about space. Why pay for 5 floors of office space when employees are just as productive from home? Major corporations are downsizing. Startups are going fully remote. And entire downtown areas, once buzzing with activity, are becoming eerily quiet. Now add e-commerce. Retail real estate, once considered prime, is now competing with the convenience of online shopping. Big box stores are closing. Malls are turning into ghost towns. Even anchor tenants like department stores are vanishing. And then comes the interest rate trap. Many commercial buildings were purchased using debt, when interest rates were near zero. That worked. But now, refinancing that debt is brutal. Cash flow is down, vacancy is up, and suddenly, what looked like a cash cow is bleeding money. Wealthy investors saw this trend early. They started pulling back. Some even pivoted into logistics spaces, storage units, or residential multifamily properties because that's where demand shifted. Meanwhile, many everyday investors are still clinging to the old playbook. Real estate never loses value. It's always a safe bet. But here's the truth. Real estate is only as valuable as what people are willing to pay for it today. Not last year, not last decade. If the space sits empty, it's not an asset, it's a liability. Commercial real estate is going through what many call a slow crash. Not a dramatic collapse like 2008, but a long, painful erosion of value. Rents drop, maintenance costs rise, and properties become harder and harder to sell. You may not see it on the news, but insiders? They're already moving on. So what does this mean for you? It means you have to stop thinking of real estate as a monolith. Ask deeper questions. Who's actually using this property? Will this location still be relevant in 5 years? Is this asset future-proof, or stuck in the past? Real estate can still build wealth, but only if it evolves with the world. And the world is evolving fast. Don't get stuck holding the blueprint for a building no one wants to walk into. Let's talk about something close to home. The US dollar. It's the world's reserve currency. It backs global trade, oil, major debt markets. Other countries hold it, trust it, even depend on it. It's strong, right? Well, not so fast. Because beneath that surface strength lies a quiet truth. The dollar is slowly losing value, from the inside out. Let's break it down. When people say, the dollar is strong, what they usually mean is, it's strong compared to other currencies. And that might be true, for now. But here's the question that matters more. What can the dollar still buy you? Here, at home? That's where things get uncomfortable. Over the past 20 years, the US dollar has lost about 40% of its purchasing power. That means what cost $100 back then now costs around $165 to $175. We're not talking about Venezuela or Zimbabwe. We're talking about the US, where groceries, rent, healthcare, and tuition keep climbing, but your dollar doesn't stretch as far. And while wages have increased for some, for most people, real income, adjusted for inflation, has barely moved. So yes, the dollar is still king globally. But here in the real world, it's acting more like a paper tiger. And here's where it gets riskier. The government keeps printing. The national debt is exploding, over $34 trillion and counting. Debt ceilings get raised like clockwork. Stimulus programs keep coming. And each time, the dollar gets diluted, like adding more water to the same cup of coffee. Looks full, but tastes weaker. Wealthy investors know this game. That's why they don't just hold cash. They use cash as a temporary tool, but store value in hard assets. Real estate, the right kind. Commodities like gold or energy. Productive businesses. Even some digital assets. Why? Because they're betting not just on growth, but against the erosion of money. They're playing both offense and defense. Earning more, but also protecting what they've already earned. Meanwhile, the average saver still parks their money in a savings account paying 1%. While inflation eats away 5 to 6% every year. That's not saving. That's silent loss. So here's the mindset shift. Holding dollars isn't risk-free anymore. The real risk is holding dollars blindly, thinking they'll keep their value. They won't. Not in the long run. Not without a plan. The dollar may still look strong from the outside. But if you don't pay attention, you might realize too late that your wealth has slowly leaked away. Right under your nose. Let's talk about something that sits in almost every driveway in America. Your car. It's shiny. It's convenient. It's freedom on 4 wheels. But financially, it might just be the most expensive thing you own that keeps losing value by the second. Here's the harsh truth. The moment you drive a new car off the lot, it loses 10% to 15% of its value. Within 5 years, it's usually worth less than half of what you paid. No matter how well you maintain it. No matter how advanced the tech. A car is a depreciating asset by design. Yet we treat it like a status symbol. A reward. Even an investment. Some people are taking out 6 or 7 year loans just to afford luxury models, stretching their budgets to impress people they barely know. And during the recent car shortage, prices soared. People were paying $10, $15 over sticker price. For what? A machine that will be worth 60% less by the time it's paid off? Let's zoom out. The average American now spends $800 to $1.000 per month on their vehicle. That includes the car payment, insurance, gas, maintenance, and registration. Multiply that by 12 months. Then 10 years. You're talking about 6 figures poured into something that never pays you back. Wealthy people think differently. Yes, many of them own nice cars, but they buy them last. Not first. They ask, will this car make me more money? Will it increase my productivity? Or is it just an emotional purchase dressed up as deserved comfort? For many of them, a car is a tool, not a trophy. Meanwhile, for the average consumer, the car is the biggest monthly liability, and they don't even realize it. And it doesn't stop there. New car models are getting more expensive. Electric vehicles are amazing, but the upfront costs are steep. Repairs are more complicated and pricier than ever. Software subscriptions, tire sensors, even monthly fees to unlock heated seats? You're not just buying a car. You're buying into an ecosystem of ongoing expenses. So what's the alternative? Buy used, pay in cash, or keep loan terms short. Choose function over flash. And most importantly, never confuse mobility with identity. Because here's the truth. The car you drive doesn't define your worth. but it can quietly erode your net worth if you're not careful. If you redirected just half of what you spend on your car toward investments, the compounding over 10 to 20 years would shock you. So the next time you're tempted by the latest model, ask yourself, is this helping me move forward, or just helping me look like I am? Sometimes, the best financial move is to stay in your lane and keep driving what already works. Let me say something that might sting a little. It's not bad investments that hurt you most. It's the good ones you hold on to for too long. We've all been there. That one stock you bought early and watched climb. That rental property that used to cash flow like a dream. That hot investment that once made you feel like a genius. And even though it hasn't performed in years, even though the numbers clearly show it's dragging down your returns, you still can't let it go. Why? Because it once made you feel right. And that feeling? It's addictive. Welcome to the psychology of attachment. This isn't just about logic, it's emotional. We don't want to admit that something we believed in no longer serves us. So we rationalize. We say, it'll bounce back. It's just a bad year. I've already put so much into it. But here's the truth. The market doesn't care how long you've held it. It only cares what it's worth today. And if you can't let go of an asset simply because it once worked, you're not investing anymore. You're clinging. And clinging is costly. Not just financially, but mentally. Because every dollar stuck in a dead investment is a dollar not growing somewhere else. Wealthy investors understand this. They may make mistakes like everyone else, but they don't get emotionally married to any one asset. They constantly ask, is this still serving my long-term goals? If I didn't already own it, would I buy it today? What's the opportunity cost of keeping this? And if the answer doesn't justify the hold, they let it go. No drama, no ego. Because here's a principle most millionaires live by. Cut your losses fast. Let your winners run. Meanwhile, many average investors do the opposite. They double down on losers out of pride. And they sell winners too soon out of fear. It's backwards, but it's human. And that's why awareness matters. The longer you let attachment drive your financial decisions, the more likely you are to miss the next big opportunity, because you're stuck staring at yesterday's gains. It's like driving while only looking in the rearview mirror. Let me ask you, is there something in your portfolio you're holding onto out of nostalgia? Something you know, deep down, has lost its spark, but you just can't part with? If so, this might be your wake-up call. Because in investing, like in life, you can't move forward while dragging the dead weight of the past. Sometimes, freedom isn't about gaining more. It's about releasing what no longer aligns with who you're becoming. Let me ask you this. When was the last time you changed your financial direction, not because things were falling apart, but because you saw it coming? That's the difference between reacting and being aware. See, wealthy people don't wait for headlines. They don't chase trends or follow the crowd. They quietly shift direction, before the crowd even realizes something's wrong. Because true success doesn't come from panic. It comes from clarity. In every financial storm, there are three types of people. 1. Those who panic and follow the herd. 2. Those who freeze and do nothing. 3. And those who calmly reposition before the storm hits. Guess which group the wealthy fall into? Awareness is their secret edge. Not luck. Not even intelligence. Just the ability to zoom out. To question assumptions. To move early when the signs are subtle. And no one's paying attention. They ask questions most people ignore. What's the real cost of this safe investment? Is this asset still relevant in the next 5 to 10 years? What's changing beneath the surface? Even if the price looks stable? Because here's what they know. Nothing is truly safe, except the ability to adapt. They don't fall in love with assets. They don't worship past performance. They trust their process, not their emotions. And sometimes, that means being early. It means buying when others are afraid. Or selling when others are euphoric. That's not easy. It's often lonely. But it works. Let me give you a truth most people overlook. By the time something feels safe, it's already overpriced. And by the time it feels risky, it might be the best opportunity. Awareness flips that equation. It lets you spot decay, while everyone else is still calling it value. It helps you exit quietly, before the crowd starts running. It's not about being perfect. It's about being a half step ahead. So ask yourself, are you observing markets, or just reacting to them? Are you thinking independently, or just echoing the noise? Because if you're still clinging to what used to work, you might miss what's starting to work. And that's the real tragedy. Not losing money, but losing time, losing momentum, losing the chance to move before it's obvious. So here's your invitation. Start looking deeper, question louder, and move quieter. Because in a noisy world, clarity is the greatest asset you can own. So here we are. 7 chapters. 7 types of assets that many people still consider safe, but are slowly, silently falling apart. And maybe, along the way, you started to question, have I been holding on to something that no longer deserves my trust? That question alone is powerful. Because the real risk in finance isn't just bad decisions. It's old beliefs that no longer serve you. We don't lose money simply because of market crashes. We lose it because we refuse to adapt. We hold on to bonds because they used to be reliable. We keep dividend stocks because they once paid well. We pour money into cars, real estate, or dollars, because they felt like wealth. But here's the truth. Wealth isn't what you hold. Wealth is your ability to choose differently when the world changes. And the world is changing, fast. The systems we grew up trusting? Many are outdated. The rules we were taught? They're being rewritten, quietly, constantly. So what do? We stay awake. We stay curious. We stop treating comfort as proof of safety. Because the most dangerous investments are not the ones that fail overnight. They're the ones that rot slowly, while still looking fine on the outside. Here's what the wealthy understand. No asset is immune. No strategy is permanent. No market trend is forever. But awareness, adaptability, disciplined thinking, those are timeless. So as we close this journey, I leave you with one final thought. Don't obsess over what to invest in. Obsess over how you think. Because once you learn to see clearly, you'll stop asking, is this safe? And start asking, is this still right for right now? And that single shift, from comfort to clarity, can change the trajectory of your entire financial life. Thank you for listening. And if this gave you even one new insight, share it with someone you care about. Because in this economy, a fresh perspective might just be the most valuable asset of all.